Hi everyone, it's Tom Gentile. Welcome to Tom's Trading Room, and in this video, we're going to talk about how to read a risk graph. So I'm looking at Federal Express, and I've got my little bull call spread already put in. I haven't saved it yet, so I want to take you through the process of what I look at once I've put a trade together and I've clicked on the Risk Graph plus button. So what you're seeing here right now is this is a bull call spread for FedEx, and the way we read this is I actually start down here, all right here in the middle where it shows what I bought and what I've sold. So I'm looking at buying the 177.5 calls and selling the 180 calls, and right now, based on the graph, it's showing me that I've got a price that's a little less than $1 right now to put these two positions on. So you can see both the bid and ask for the 177.5 call, see here at 263 by 305, and then the 180 call, which is 177 by 199. All right. At this point, if I were to actually get filled at both of these prices at this point in the day, I would see no profit or no loss. All right. I'm looking at the implied volatility of each option, which looks relatively low. All right, I've got volume for the day. I've got open interest on the contracts. I've got the number of days to expiration. The deltas, obviously the positive one shows that I am long, all right, long the call option, and the negative delta shows that I'm actually short this particular call option. I can also see Greeks such as Gamma, Vega, and Theta based on where we are at this point in time. Now, if we move up a little bit, you can see here that I have the ability to click on stock news for FedEx. There's the dividend rank percentage that's actually put in and the last time a dividend was paid. All right. I've also got some statistics on the quote types. All right. This being the mid quote. I'm looking at the mid quote if I were actually to be able to split the difference between the bid and the offer. All right. But it also shows me here things like profit, rate of return, the maximum profit that I could see on this trade if I were to actually hold it all the way through expiration and Federal Express were to go above 180 by that time. I have the maximum risk, and this is on a per spread basis, $96. Shows my combined delta. Taking the positive delta from the negative delta, you can see the combined delta of the two. We call that position delta. You also see position gamma, theta, and vega as well. All right. The graph itself is pretty self-explanatory. You can see here on the left-hand side, I see a chart of an ever-rising stock, which is FedEx. I also see the chart of the bull call spread. This is what we call a modern graph. A modern graph looks like this. Wherever the price of FedEx, in this case on the chart on the left-hand side is, I'm able to immediately go over and get an idea of where I am in terms of theoretical profit or loss before I take the trade off. Now, this particular chart shows from 123 to 230. If I want to squeeze that in, say from about 165 to 185, what I'm going to do is I'm going to scroll to the bottom of the screen, and I'm going to put 165 in the lower stock limits graph and 185 in the upper. I'm going to go ahead and apply those settings to the risk graph. And now what's going to happen is it's going to reset that window, and it's going to show me a stock window that's in between 165 and 185. As you can see here, 165 on the downside, 185 on the upside. But this is the more important thing. It actually increased and blew up, if you will, the risk graph, showing me exactly where I am in this trade. All right, if I were to put this on the theoretical profit and loss, and this would be today, and this would be going forward to expiration. And then, of course, I also see where we are if I go up and where I would be likely to be in terms of loss if we were to go down. All right, a couple other things I want to show you is these two charts below the risk graph. This is a chart of the implied volatility. And these are, this is an average implied volatility of options. The red is the short-term options, 7 to 30 days. The blue is the 30 to 60 day. The green is 60 to 90 day volatility. And then greater than 90 days is going to be shown in black. All right. The chart to the right of that is the Vega chart or the profit chart based on volatility itself. All right. Next. Down here, we can actually put our trade plan in. We can save that trade plan. So if I were to come in and say, all right, you know what, my trade plan is money calendar by for FedEx, and then I've got my technical stop loss, and maybe I come back up and I look at that graph and I say, all right, where would I get out of this trade if it just fell apart? And really what I'm looking at is maybe below 174, which is right before is the low on the gap up that occurred on this stock just a few weeks ago. So I could put a technical stop loss in of 174 for my trading plan. I might also put a technical profit target in at 185. If we hit 185, why not just get out? All right. Look at 1 to 2% as far as a position size. The stop loss is obviously the cost of the spread. Okay, in this case, and the profit target would be the profit of the spread, the most that I could actually get. And then time stops are going to be December expiration. This is an example of putting together a trade plan. All right. Everything else that you're going to see here are settings. We could actually we're looking at profit loss in dollars, but you can actually change this, and you could look at the combo price. You could actually look at the risk graph of delta, gamma, theta, or vega on this, not just the profit and loss on the dollar amounts. All right, there are other areas in here that you can put in, such as statistical volatility, implied volatility. Do you want to space out the grids on the stock itself in the IV? I showed you how to do the stock limits, but there are several other areas in here in terms of limits to the stock, limits to the implied volatility. You can also look at risk graph days before expiration. It doesn't have to necessarily be the graphs that the computer automatically generates for you. And then down here at the bottom, finally, it's going to show you statistics and probability. What has the stock been doing in terms of statistical volatility and range movement itself? The last 100 days all the way down to the last 6. And then you can look and see the probability of profit. And what you're going to find is in this case, and in a lot of cases, if you're going to put on a trade, an option trade, where you are net paying out something, all right? In this case is a debit, and this is an at to out of the money spread, then it's going to have slightly less than the 50% probability of profit. If we were in the money, then that probability of profit would actually be higher. And this is based on non-random movement between now and expiration. All right. This also shows you things such as odds of success, maximum profit, maximum risk, and of course the percent to double. How far does the stock need to move before you see a double in your option trade? All right, guys. I hope you enjoyed this video. We've got many more coming to you. And we'll see you then. Thanks for joining me.